Occupancy rates remain tight. Rent growth numbers continue to be strong across almost all of Denver's product niches and submarkets. And now we're starting to see some job growth numbers that are more in line with the strength that we've seen in the local apartment market. Welcome to Apartment Market Dynamics from NPF Research. I'm Jay Parsons with your Denver update. Denver has been an interesting metro in that the job growth numbers that we've seen over the past couple of years have not been in line with the level of strength that we've seen in the local apartment market. But last month, the Bureau of Labor Statistics revised its job growth numbers from 2011, and they're now showing that the Denver area actually gained 22,600 jobs compared to the initial report of 12,200 jobs. And that growth pace has continued to pick up through the first quarter of 2012. As of February, the BLS had Denver with a net gain of 29,600 jobs. That is the 10th biggest increase in the country, and it means the local employment base expanded 2.2% over the past year. So, the apartment sector. The Mile High City did hit a seasonal slowdown in 2012's first quarter, and that followed some better than expected numbers in fourth quarter of 2011, so that sort of make it a wash over the past 6 months. From first quarter in particular, occupancy fell 0.4 points in the quarter, and rents were basically flat, inching up 0.1%, so not as strong as we had been seeing. But overall, the numbers do look good. Occupancy at 95% on par with the pre-recession norms, and furthermore, the year-over-year numbers still look very good. Occupancy up 0.9 points annually, and rents up 6.5%, and that is one of the nation's largest rent hikes. And as I mentioned earlier, the numbers look very good across all of Denver's product niches. Let's take a look first at product age groups. Occupancy rates around 95% in every niche. A little weaker in that 2,000 plus group at 94.5%, but nothing to complain about there. And here's annual rent change by product age niche on your screen now. Big numbers across the board, and getting just over 7% in apartments built in the 2000s and in the 1980s. And here's another view of the data that we've introduced with our revamped reports in first quarter, breaking down performance by building height. And you can see the occupancy rates are especially strong in taller properties, 96.2% in high rises, which we classify as buildings with 7+ stories, and 95.5% in mid rises, which are properties with 4 to 6 stories, compared to 94.8% in low rises. And annual rent growth was also strongest in high rises and mid rises, with hikes of nearly 8% annually, compared to a still very strong 6.1% hike in low-rise properties. And let's take a quick look at a couple submarkets. We revised our boundaries this quarter, and we are now offering 20 submarkets for the Denver-Boulder metro area. One of the best has been Central Denver. Occupancy at 96.6%, up 2.1 points annually, and year-over-year rent growth of 10.5%. And another great performer has been Highlands Ranch down in the southern part of Denver. Rents jumped a metro best 11.1% year-over-year, while occupancy climbed 2.3 points annually to 96%. For the metro overall, we expect revenue growth to remain significant over the next 4 quarters. Look for occupancy to climb another half point or so, and for rents to jump another 6%. And that wraps up for Denver. So until next time, for Apartment Market Dynamics and NPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.